All right. Good morning and good afternoon. Sorry, and assalamu alaikum. So let's start. You can see the slide on your screen. We have covered different types of costs which are there in a business, right? We have discussed about why cost data is important, why businesses need to know about their cost as well. So we discussed these points as well. Okay, why knowing your cost data is important as a business. We have discussed that as well. Now we are going to discuss um, yeah, problems in classifying costs. We discussed that even as well. Like we were actually discussing that labor cost can be direct or overhead. Now, direct costs are normally variable costs. Normally, although the definition is different, I told you earlier. Um, it can be overhead as well. Like for example, if I say that a worker is given a certain wage on the basis of the items produced by the worker, right? Like let's say $2 is given for each unit produced, right? So obviously this is a direct cost. Why? Because you can easily identify that cost from each product. Like for one product, there will be $2 of labor cost. Similarly, if two units are produced, then $4 will be the labor cost because the labor is actually given $2 per unit. So this is a direct cost, right? But it can be an overhead as well. That is the problem. How? For example, if the same worker is given a salary, now a fixed amount is given to the worker. Doesn't matter how much worker is producing, right? So here, this is an overhead cost. Overhead means fixed cost, and it will not vary with the change in the number of units produced. Either the worker produces more or less. So because labor cost can be direct or it can be overhead or indirect as well. That's why sometimes it becomes difficult to identify that because you need to identify that so that there'll be a clarity that okay, this is your fixed cost, this is your variable cost, okay, and then you can make some changes accordingly. Like what changes you want to make? Like variable cost, we understand when output increases and you sell more, you have to spend more as well, right? This is variable cost, huh? Which changes with the level of units produced and sold in the market. But fixed cost is more crucial. Why? Because it stays the same, fine, but you have to pay it at any cost. Like it doesn't matter you have produced something or not, you have to pay it. That's why you need to have a check on your fixed cost, whether it is on the higher side or not. Because if the fixed cost is a major portion of your total cost or significant proportion of your total cost, then there's a problem because that is a cost which you have to pay all the time. So then businesses they really face problem in paying their cost. But if fixed cost is a smaller proportion, then it becomes easier because variable cost will only be paid when you will be producing it and selling it. So you can cover that cost by the amount you will get when you will sell your product, right? So then it becomes easy. But so that is why uh, uh, because the problem is here in identifying a labor cost, whether it is a direct cost or an overhead cost, you cannot actually say it all of a sudden. You have to see it first. So that is one of the problem in identifying the cost. And I told you why identifying cost is important. Now, telephone charges, similarly, telephone charges can be fixed or variable as well. We like you know that in if I talk about PTCL, na, so there are two types of charges. One is line rent, which you have to pay all the time. Doesn't matter whether you make phone calls or not, right? That is a fixed cost. Okay, either you make phone calls or you make more phone calls, still the line rent will be the same. But if I talk about call charges, that actually varies with the number of phone calls made by you, right? So if you make more phone calls, more call charges will be there. If there are fewer phone calls, fewer phone call charges will be there. So telephone charges also is a mixture of fixed and variable cost as well. So that's why whether we should consider that cost as a fixed cost or variable cost, there is also a problem there in in it. All right, now moving on to discuss problem of allocating fixed cost. Now that is the problem. One is yes, there is a problem in classifying cost, whether it is a fixed cost or a variable cost or a direct cost or an indirect cost. We just discuss some of the examples. Now, let's talk about cost. Cost is normally a variable cost. Why? Because it is a fixed cost. Okay, either you make phone calls or you make more phone calls, still the line rent will be the same. Now another why, because you cannot simply identify fixed cost on any of the item, because I told you generally fixed cost is an indirect cost. So for example, if I talk about rent of the building, so how can you put that rent on each of the items which you produce inside that building? Okay, let's say you make pens. Put that rent of that building on each pen you manufacture, you produce, obviously not, huh? So that is one of the problem, that what should be the criteria through which you can allocate fixed cost on each of the items sold. That is one of the issue there. And let's discuss the points which actually make it more complicated to allocate fixed cost. First is, these costs may not be directly attributable to or associated with the production process, and therefore it may be difficult to allocate. I told you earlier that fixed costs are generally indirect costs. That's why they are difficult to identify, okay, for each product, because that is the total amount which is given: rent of the building, interest on loan. Okay, that is a total amount which is there. So salaries of the workers. So you cannot actually allocate it on each item you produce. That is one of the problem. Second is, it may not be appropriate to allocate them to production. The allocation of these costs may make the production appear less profitable and lead the management to make a poor decision. Yes, that's right. Again, that is a problem. That if we allocate fixed costs, there will be a problem. Let me give you an example. Let's say you are actually paying rent of the building, that is, let's say, 1 lakh. Okay, and you are making the same pens. Okay, in that building, right? Now let's say the cost of producing that pen is, let's say, uh, mm, $5. Okay, and you are selling it at $10, right? So still there's a margin of $5. Okay, so it looks that it would be profitable in the future as well. Okay, but now if you add your fixed cost in it, now 1 lakh, so you will say, okay, so we are getting $5 from each pen. Okay, apart from your variable cost, because your variable cost is $5, and the price you are getting by selling the pen is $10. $5 is actually the amount you are getting over and above your variable cost. But if we add fixed cost in it as well, so that is 1 lakh. So now it will appear as that business is suffering loss, and maybe that is not a good decision to produce pens. Although it is a good decision many a times. Why? Because fixed cost does not increase. So when you will keep on producing and selling pens, and you will keep on getting the revenue from the market by selling pens, the time will come when you will be able to cover your fixed cost as well. That 1 lakh. Like, let me give you an example. Just a minute. Let me show it to you. Like, for example, I just told you that we manufacture pens, right? And the cost of one pen is $5. This is the cost of pen, right? And the price of that pen is, let's say, it is $10. Okay, so you are still getting $5 over and above your variable cost. This is cost of pen, that is actually variable cost. And you know that there is a fixed cost as well to find out the total cost. Okay, but right now we should not add fixed cost in it. There's a reason. Let me explain you. So if variable cost of pen is $5 and price is $10, so $5 the business is getting, right? This is over and above the variable cost. This is the amount the business is getting. Okay, this is what we call, this amount is actually called, let me write it here, contribution. This is not a profit, remember. Why we call it contribution? Because the formula of contribution, this is contribution, sorry, per unit. Okay, contribution per unit. How? Like, the formula is selling price minus cost of or you can say variable cost of bottom material or variable cost. That is a better way to uh, describe it. Now this is contribution per unit. Selling price में से variable cost अगर हम निकाल दें, so that is 5 ना. We can see that 10 minus 5, 5 आ गया हमारे पास जो the amount which is over and above variable cost. Okay, now why it is called contribution? Because let's say now let me add one more cost here. I'm adding fixed cost here as well, or let's say it's overhead. It's the same, huh? Fixed cost or overhead. It has the same meaning. Let's say it is $100,000. Okay, this is your fixed cost. Fine. Okay, now the problem is the amount you are getting now, right now, that is what we call contribution. It is not as same as profit. The reason is because all costs have not been subtracted from it. You know that total cost includes variable cost plus fixed cost. Right now, we have just subtracted variable cost from the selling price and not the fixed cost. Okay, so that is why it is not called profit. Okay, unless and until we subtract the other cost as well, that is overhead from the revenue or the price. Okay, so this is contribution, and why we are calling it this is not profit, you understand now, but this is not why we are calling it contribution, because it is now contributing towards covering fixed cost. So I can write it here. If I say contribution per unit is $5, contribution per unit is $5. Okay, what does it mean? It means that each item is contributing towards covering fixed cost. Okay, like every item you sell, it is contributing $5 extra after covering your variable cost, right? Okay, so it means it is actually contributing towards fixed cost. So overhead is 100,000. So now after selling one pen, $5 is covered from the overhead, right? Similarly, so if you keep on selling items, and let's say you are able to sell 20,000 pens, okay, so now what is your total contribution? Obviously for each, from each pen you are getting $5 contribution, right? So what will be the answer? That will be 100,000, same, right? This will be $100,000. Now it means, so it means if you keep on selling your products, okay, and you do not consider your overhead first, it could be a good to see how, because by the time you reach 20,000 units, you'll be able to sell it. You will be able to cover all your fixed costs as well, because if 20,000 into 5, 5 is the contribution per unit, and 20,000 is the number of pens you sell. So 100,000 now of overhead now fully covered. So it means now you have achieved what we discussed. We call it, you have achieved break even level, and that is what we call, whatever amount you are getting, that is what we call total revenue, is equal to the total cost. And you know that total cost includes fixed cost plus variable cost. तो वेरिएबल कॉस्ट तो पहले कवर हो रही थी ना, वो देखिए आप ऊपर $5 की वेरिएबल कॉस्ट थी एंड प्राइस वाज $10, तो वो तो ऑलरेडी कवर हो रही थी. एक्चुअली एक्स्ट्रा आपको $5 ऊपर मिल रहे थे. तो अब वो एक्स्ट्रा $5 जो है ना, वो बन गए हैं 1 लाख, क्योंकि अब नाउ यू आर एबल टू सेल 20,000 आइटम्स. तो अब फिक्स कॉस्ट भी कवर हो गई 1 लाख वाली, और वेरिएबल कॉस्ट भी कवर हो रही है. दैट मीन्स दैट द बिजनेस हैज अचीव्ड ब्रेक इवन लेवल. एंड आफ्टर दैट if they now sell further, so each item now they will sell, now they will start getting profit, because now their all costs have been covered. वेरिएबल कॉस्ट तो साथ साथ कवर हो ही रही है, वो हमने बात कर ली है, और ओवरहेड बढ़ती नहीं है, फिक्स कॉस्ट सेम रहती है. नाउ यू हैव कवर्ड इट एज वेल. सो नाउ वट एवर आइटम यू सेल आफ्टर 20,000, after 20,000, that will be the profit of the business. So break even level is basically 20,000 pens. So now we can make it profitable business, right? Because now after selling more than 20,000, business will be getting profit. But imagine if we consider overhead as well in the cost, so we will see that the business is suffering loss, because fixed cost is still not covered. You know that only $5 is coming from each of the product. Okay, uh, over and above variable cost. So fixed cost is to be covered. A lot of cost is there. 100,000. आपको तो हर यूनिट में सिर्फ $5 मिल रहे हैं एक्स्ट्रा. So You might not decide to run your business or to take a certain decision. Huh? That would be wrong in that case. So that's why overhead costs should not be allocated to products, because if we allocate overhead to products, the cost will look too high, and then it will look that it will be unprofitable to produce the products or to take a certain decision. And that is why that is again one of the problem of allocating fixed costs. That's why generally in some methods allocate fixed costs. Yes, it is recorded, but it is not actually allocated to each product. Otherwise, a profitable decision may look like an unprofitable decision as well, as I just told you. Because now you see that the decision we took earlier, yes, at the start there was a loss because contribution was there, fixed cost was still to be covered, but in the end, after achieving 20,000 units of pens, now the business is able to achieve profit after when business will start selling more than 20,000 pens. So this is how, and I explained you the concept of contribution per unit as well. So this is about this first point. Sorry, the second one, that it may not be appropriate to allocate them to production. क्योंकि अगर आप करते हैं तो the allocation of these costs may make the production appear less profitable. वो लगता है स्टार्ट में, ऑब्वियसली बात है, क्योंकि कवर नहीं हुई थी ना कॉस्ट, एंड लीड द मैनेजमेंट टू मेक अ पोर डिसीजन. और इवेंचुअली जिसमें बहुत प्रॉफिटेबल होना था लेटर ऑन, वो आप डिसीजन पहले ही रिजेक्ट कर देते हैं, और फिर वो प्रॉफिटेबल डिसीजन आप नहीं लेते बिजनेस. तो बिजनेस might miss the opportunity of earning lots of profit in the future. Similarly, another problem of allocating fixed costs is it may occur due to the difficulty of calculation or forecasting of those fixed costs. Yes, it's difficult, it's hard to predict fixed cost because fixed costs remain the same, I told you earlier, but it can change. I told you earlier, fixed cost does not vary with the change in the level of output. Yes, that's right, but it can change in the future. Okay, the owner of the building may decide to increase the rent of the building. The interest charged by the banks may increase as well. Workers may start demanding higher salaries. So it's not that easy to predict fixed cost. Huh? Variable cost is easy to predict. Why? Because you know that when you will increase your production, so your variable cost will also increase. So you can calculate that. But whereas fixed cost is concerned, it has nothing to do with the output. So it can change anytime. So that's why it's hard to predict, and that's why sometimes whatever cost figure you get, that is not actually the true figure. And if you use it in your calculation, or if you allocate it to your products as well, so that may give you a misleading figure as well. Okay, any question regarding problem or problems of a fixed cost? You can ask if you have any issue. So there is no issue, right? Should I assume that you have no problem? Okay, all right. So it means I can move on. Fine. Okay, let me just take a screenshot of your name. So, all right. So moving forward now, see what is break-even? We discussed it. Break-even is a point where total revenue is equal to total cost, and it is actually faced by every business because once business starts, they are at a loss. Why? Because fixed cost is still to be covered. So that's why they keep on producing and keep on selling, and then the time comes when they are able to cover all their costs, huh, as I just explained. So that is the point. That is what we call break even, and after that, profit starts. We'll see it with the diagram as well. So we'll see the break even method with the help of graphical method as well and equation method as well. Okay, the formula to calculate break even level through equation method is this: fixed cost over contribution per unit. So I explained you the concept of contribution, right? So, and I'll use the same example I gave you earlier, right? So where contribution per unit is selling price per unit minus variable cost per unit. I have already explained you that. Okay, margin of safety. We need to understand that as well, and then we'll move on to the break-even point, right? Okay, what is and then okay, we'll discuss about the graphical method and the equation method as well. Okay, All right. So margin of safety is by basically tells that how safe a business is from the loss. Like even if business loses a sales by a certain number of units, still business will not suffer loss. Now, what does it mean? Let me explain you that. Now, let me explain you first. Let me draw the break even. I'm just doing it freehand, so no values actually are there right now. So, okay, you know that the total revenue curve always starts from zero because if there is no production, there will be no sales as well. So, total revenue curve always starts from the origin. Okay, total revenue. So, we take x-axis here and we take y-axis here, and on x-axis we take output, and obviously we assume whatever output that is produced is sold in the market as well. That is the assumption. Although it's a wrong assumption, but we assume that while using this concept that whatever we produce, it is sold in the market. Okay. After that, on y-axis, what do we take? We take cost and revenue. Cost and revenue, right? This is revenue. Okay. Cost and revenue, and now I'll draw a cost curve. Cost curve normally starts from there. Do you know why? So at zero level output, total cost is never zero. This is total cost. Let me draw total fixed cost curve as well now, so that you will have a clear picture about it as well. Now this is actually a fixed cost. You know that it actually we I did plot the fixed cost curve earlier as well. Fixed cost curve is actually a straight line, a complete horizontal line, right? This is a fixed cost, and this shows that doesn't matter whatever happens to output, fixed cost is not going to change. Now you can see that let's say if this fixed cost is, I'm just taking it, let's say it is 100 here in that case, okay, 100. So and if output is zero here, output is zero. So at zero level of output, the fixed cost and total cost are the same. And what is the reason? I told you earlier, total cost is equal to fixed cost plus variable cost. Okay, you understand this. So if output is zero, for example, if output is equal to zero, so what happens that total cost will be, fixed cost will remain the same. It doesn't matter whether there is zero level of output or greater level of output. Fixed cost is not going to change. That will be 100, right? And variable cost will be, the formula is, I told you, variable cost per unit. Okay, whatever the variable cost per unit is right now, I have not given it into a number of output. So what is the output? Output is zero. So obviously, variable cost will be zero. Okay, total cost, that will be 100 plus zero. That's why when output is zero, total cost is always equal to fixed cost, because variable cost is zero. That's why. So that's why total cost always starts from the point where fixed cost is. Okay, and total cost is never zero at zero level of output because of fixed cost. Okay, and now you can see that there is an intersection between total revenue and total cost. Okay, and this is what we call break-even point. This is break-even point, and let me write it there. This is break-even. This is break-even point, right? Point, break-even point. Okay, break-even point. All right, and if I drag it towards x-axis this way, so this is what we call break-even level of output, and this is what we actually find it out. Let's say this is 50. So our break-even level of output is 50. That if business is able to sell 50 units, then we will be able to achieve a break-even point, and that is equal to total cost. Let me shade the area. If I talk, actually shows what it shows. total revenue is less than total cost throughout that area. You can see that total cost curve line is above than total revenue curve. So when total revenue is less than total cost, we call it loss. So this area is actually called loss. So as I told you that at the start all businesses they suffer loss, okay, and then they gradually achieve their break-even point, and finally they start getting profit. So now let's discuss that area as well. Let me shade that as well. Okay, and this is actually the area. This one. Now this area is actually profit. Why it is profit? Because in this area total revenue is greater than profit. Total revenue is greater than total cost. So, and throughout the area, you can see that total revenue is the total revenue line or curve is greater than the total cost curve. So that's why this is the area of profit there. Okay, this is so we can write it. This is profit, and all businesses. So that's why all businesses they want to achieve break even early, so that profit will start early, right? Now, let me give you an example. For example, the business has achieved break even level. Okay, and right now the business is at this point. Just a minute, let me use a different color. Let's say the business is at right now at this point. Okay, and let's say let me use a value for it. Let's say it's 100. Okay, this is what, let me write it here. This is current level of product, current level of output. What does it mean? Right now business is producing this much output, and business has achieved break even level of output, that is 50. Okay, now if I need to calculate safety margin, I told you earlier what is it. It basically tells how safe the business is from the loss. So how do we calculate it? Safety margin, safety margin, right? And how do we calculate that? We calculate it this way. Let me use this phrase. Uh, we say current level, current level minus break even level. Break even level. This is actually the formula to calculate break even. Sorry, safety margin. Okay. So now in this case, the example I gave, if I use the values, current level is how much? 100. Okay, and break even level is 50. So answer is 50. Okay, so I'll say that the business safety margin is 50. But now what does it mean? It means if business loses sales by 50 units, if business loses sales by 50 units, still business will not lose because drops during the period of time or during the year, right? So that's why you need to understand still if your sales is falling, fine, but if you have safety margin, maybe we are still at a profit. So that's or how many units business can lose, how many how much sales business can lose in terms of units before suffering losses. This is our safety margin. Okay, now any question regarding break-even chart? Because then we will talk about its calculation as well. If there's a question, please let me know. I'm waiting. Any question, you are welcome. So there is no question. It means you are clear about it. Aliza Yasin Malik, is that clear now?
Yes, sir.
Okay, all right, good, fine. Okay, now moving onwards. Now let's get back to the slide, because we I will draw the break-even chart using values as well. Okay, but I might do it in the next class, because then we'll be completing that chapter as well. Now, moving onwards, we have discussed about okay. Now, one thing which is left, that is using calculation method, and let's do it as well. Now, this is what we call the graphical method to find out the break-even level. Okay, there is another method, calculation method. Calculation. Let me use another color because it might not be visible to you. Okay, now calculation method. Now I'm using it. Break-even level. Okay, all right. So if session expires, you need to come back again, right? So don't go away. If session expires, you need to come again. Break even. Now, uh, this is the formula, na? Fixed cost divided by contribution per unit. Contribution per unit. That is the formula. Contribution, we discussed it. That how much a contribution is there from each product to cover fixed cost. Okay. All right. So in that case, let's say fixed cost is 100. Let's say uh, no, it's not actually, it's not given. Okay, all right. So formula is there, and when we'll actually draw the break-even chart using values, I will use this formula as well. Like I will actually discuss the calculation method as well and graphical method as well using the values as well. So now let's move onwards. Now this is a break-even chart, and we have discussed it, so I'm not going to discuss anything in it because we have discussed that. All right. Now, uses of break-even analysis. Remember, break-even level of one thing, we are able to find out break-even level of production, and that is very important. You know that. Why? Because if business knows about what is their break-even level, so then they will set that target so that they can start getting profit early. Why to? Because when you know what is your break-even level, you might take some steps or measures to achieve your break-even early as well. And why do you want to achieve break-even early as a business? Because the early you achieve break even, the earlier your profit will start as well. Because the area above break even is the area of profit. You know that we just discussed it. That's why this is one use of the break even analysis, margin of safety. I discussed it, so I'm not going to discuss that again. That is very important because when break even chart is there, then you will be able to find out the margin of safety as well. Then impact of price increase. Again, you can see that as well. If you change your price, what will happen to the break even as well? I'll show it to you just a minute. Then similarly, impact of purchase of new equipment with low variable cost. Similarly, if you buy equipment whose variable cost is low, running cost is low, for example. So again, you can see the impact on the profit using the break even as well. So let me just tell you how it is done. All right, we can use these values later on in calculations. Okay, all right. Now let's say this is a break even. Okay, session can expire anytime, so you have to come back again, right? So don't go away. I'm telling you again. So join quickly as soon as session expires. All right. Now let's say this is the total revenue. Okay, you know about it. This is total cost. Let me quickly label it. Total revenue. This is total cost. Okay, and this is, let's say, the break even. Okay, this is the break even point, and if we drag it downwards towards x-axis, we'll get the break even level. Okay, now let's say the business decides to increase the price level. When price level will increase, then let's assume that people keep on buying. Okay, you increase the price and people keep on buying, so it will have an effect on total revenue. Remember, total revenue will change. Okay, it will. Oh, the slope will change actually. Total revenue will start going up quickly. Why? Because you have increased the price. So now you are getting higher revenue from each item sold, right? So that's why the total revenue slope has gone up. TR1, let's say it's TR1. So now what you can see that now break-even is achieved earlier, okay? Because before that, break-even was at that point. Now, because of increase in price, if consumers keep on buying, remember, that is the condition I'm using. So the break even can be achieved earlier as well. So you can, and your profit will start early. Remember, okay? This is the point because earlier, what was so you can bring your break even level down as well using different strategies, and you can see the impact on the break even as well. Now, okay, the impact on profit. Now, see that earlier, what was actually the just a minute, just a minute. Yes. Now, see, this was the profit area. Let me